Okay, other deductions, penalties, and loss disallowances. This chapter just contains a lot of kind of miscellaneous things. We're not going to cover everything in the chapter. Here's the lecture overview. Be sure and look on eCampus at the pages in the chapter that we're actually going to cover. Okay, first let's talk a little bit about worthless securities. So this can be a deduction for you if your securities become worthless. Now, loss on securities that became worthless during the year. So you have to take it in the year that they became worthless. Here is a link to some more information about this if you want it, but let's look at an example. Meredith bought shares of XYZ Inc. for $100 per share 3 years ago. Ouch, the prices have fallen to a nickel per share. So, can she take a deduction for a worthless security, and how much? Well, no, she can't take a deduction for a worthless security. Worthless means worthless. You can't even sell it for a nickel. But you can see here that even though the price is drastically low, there's still a market for it because she can come up with a price for it for a nickel a share. So if she goes ahead and sells them for a nickel, she can take a long-term capital loss of $95.95 per share, but it wasn't worthless. This is the thing. Now, if a stock really becomes worthless, there's no market for it. And so it's difficult to determine really the exact day when a stock becomes worthless. And so we have what we call an artificial sale date. It's the last day of the year in which the securities become worthless. And so for most people, that's going to be December 31st. Now, by setting it on the last day of the year, it gives it the biggest possible chance that it will become a long-term loss. It's because this causes the holding period to be long-term unless the security was purchased on or after the last day of the preceding year. We'll talk later about, when we talk about capital assets, we'll look at why you would care whether a long-term loss or whether capital loss is long-term or short-term. But anyway, here's another example. On December 1st, 2014, Sally purchased stock for $10,000. The stock became worthless on June 1st, 2015. She is treated as having sold the stock on December 31st, 2015, which is the artificial sale date. And so the result for her is going to be a long-term capital loss. So here's another example. On December 1st, 2014, Scott purchased stock for $10,000. The stock became worthless on June 1st, 2015. Now, for tax purposes, a short-term loss actually would benefit Scott. And so Scott's financial advisor did what's called a book sale on June 30th of 2015, meaning Scott sold the stock to the broker for a penny. This is a book sale. So this set the sale date as an actual date rather than the last day of the year, so that Scott had a long-term capital loss. So you can have situations like that. Sometimes you can choose whether it's a long-term or short-term. So if a short-term capital loss would be beneficial, have the broker do a book sale for a worthless security, if doing so would result in the short-term capital loss. Okay, let's talk about losses of individuals. This is a loss disallowance. So you can have losses in your life, financial losses in your life, that you do not get a deduction for. Personal losses are generally not deductible. So here's an example of a personal residence. Luke buys a primary residence for $300,000. This is his cost basis in the property. He sells it 5 years later for $250,000. So the $50,000 loss can't be deducted on his tax return. He was not happy to hear this. But okay, here's just a question to you that is small dollar amounts, but I think that it will be a good test of your understanding. A client asks you if she has to include the proceeds from a garage sale in her income. Most people don't, of course, but she's wondering if maybe she's supposed to. So how do you answer? Well, presumably you sold the personal assets at a loss in spite of the positive immediate cash flow. So just because you have cash come in doesn't mean you don't have a loss, right? So you really had a loss, not a gain. You can't deduct personal losses, so you sure don't have to report the income. All right, and you don't have to report the cash inflow because you really had a loss. Oh, that's kind of a depressing answer. Okay, another example. Nissa buys a primary residence for $400,000. This is her cost basis in the property, right? She would like to sell it 3 years later, but it's only worth $250,000. She's going to move, but she's going to have a $150,000 loss, and it's not even tax deductible. So, remember these personal losses are not generally deductible. So here's what she's going to do, which a lot of people think of, it could very well be a good idea, is instead of selling it, she's going to rent it out. So this is a conversion of a personal residence into a rental property. So Nissa decides to convert the home to a rental property instead of selling it, partly so she can take the loss. Well, let's see how this works. Will this allow her to take a loss in the home because the home is now investment property, not personal property? So remember, she bought the home for $400,000. At the time of the conversion, the fair market value was $250,000. So the basis of the property at the time of conversion changes. It's no longer $400,000. As a rental property, the basis becomes the lesser of the taxpayer's basis in the property, which was $400,000, or the fair market value, $250,000. So, okay, going to have a basis of $250,000. So, she sells a rental home for $230,000. So how much loss can she take? The selling price is $230,000. The basis is $250,000. She's got a $20,000 loss. Yes, that is deductible, and that part of it's good. But recall, her total loss was really $170,000. She bought it for $400,000. She ended up selling it for $230,000. So the point here is converting to a rental does not allow a person to take a loss on the formerly personal asset portion of the loss. Okay, but the losses after the conversion can be deducted as a loss. So the loss of $20,000 is a loss on investment, not a personal loss. So this is an unfortunate result for the taxpayer, but it's important to understand this because you get this question really a lot. Because investment losses are generally deductible. Another question to you. You go to Antiques Roadshow and find out the statue you bought for 50 cents at a garage sale is now worth $50,000. Hooray! That's so great. But personal losses are not deductible, but personal gains are taxable. So you will need to report the gain on your income tax return. So when converting a home to rental, get the basis as high as possible to reduce any future gain or increase any future loss. Don't do anything unethical or untrue, but really work at trying to figure out the highest legal basis you can get. Let's talk about wash sales. This is another loss disallowance. So let's just review some vocabulary, realizing and recognizing a loss or gain on stock. So we talked about this earlier in the course. So recall that no gain or loss is realized or recognized until the stock is sold. So when you hear the term realized, what you mean is that the loss or gain has actually occurred for tax purposes. In other words, you have sold or otherwise disposed of the stock or whatever your capital asset is. And when we use the term recognized, we mean included on the tax return as part of gross income. Okay, so example, stock has a basis of $5,000. It's currently worth $3,000. So realizing and recognizing that loss will reduce your taxable income by $2,000, which could be a good strategy. There are, and we'll talk about that again later on in the course, about why and when this might be a good strategy. But remember, our topic here is wash sale. So now that we've reviewed the vocabulary, let's look at an example of a wash sale. So Zach buys 100 shares of XYZ for $2,000 in year 1. At the end of year 3, the shares are worth $500. So, they've gone way down in value. Now, he'd like to sell them and show a $1,500 loss on his tax return in year 3 to reduce his taxes. So he could just do that, but the problem is that he believes XYZ may increase in value, so he really wants to continue to hold those shares. He doesn't really want to get rid of them. So he comes up with a really good idea. He's going to sell the shares for a loss, and then repurchase the shares for the market price of $500 30 days later. Now, so he still has the shares, but what he's thinking is, I can show the loss on my tax return. Now, I made 30 days here big. It could have been, he could have sold them 30 days later or 29 days later, or repurchased them 30 days later or 29 days later. But 30 is a special number because now we're going to define wash sale. It's a sale at a loss and a repurchase of substantially identical securities within 30 days before or after the sale. Okay. One key word here is a loss, a sale at a loss. Okay. Now, okay, so that's the definition of a wash sale, which obviously he just did. So what's the problem with doing a wash sale? You can't deduct the loss. So this didn't do him any good because he is in substantially the same position he was before. So the loss is disallowed. Okay. He sold the stocks, but he's really in the same position because he bought them back. So the disallowed loss is added to the basis. So he paid for the new shares, $500. The disallowed loss, $1,500. So the basis of his new shares, $2,000. So, as planners, is there a way for clients to take a loss in the return, but not really change the portfolio much? Well, the answer to that is the word substantially identical securities. You have to buy or sell 30 days before or after the sale. You have to buy or sell substantially identical securities. So, here's a website with just some more information for you if you would like, but for your learning convenience, I have summarized what substantially identical stock or securities is. One, it's the same stock, so obviously that would certainly be more than substantially identical. Substantially identical would be an index mutual fund from one fund company and another index fund tracking the same stock index from another mutual fund company. Now notice the word is the same stock index. So if you find something tracking a similar but not identical same stock index, then that would not be a substantially identical repurchase of the security. Corporate stock awarded as an incentive plan, stock and warrants or options, and some convertible bonds. So, things that are not substantially identical, index funds and actively managed funds, two actively managed funds, stocks in two companies in the same industry. So, you can sell something, take a loss, and really basically not change your portfolio allocation easily. So to get around the wash sale rules, for one thing, you could just wait 31 days to purchase after the sale, or you can actually buy prior to the sale, 31 days. You can buy stocks in the same industry, but just not the same stock. For stock or bond funds, you can buy a different actively managed fund, for example. So it's easy to get around wash sales, but you really want to watch them because clients are not going to be happy if you inadvertently buy something soon afterwards or soon before that sale, which falls into the substantially identical category, and then they can't take a loss. So avoid wash sale loss disallowances by watching that 60-day window and not repurchasing substantially identical securities.